Bismillahirrahmanirrahim. In this lecture 8E of Real Statistics and Islamic Approach, we will study how statistics are used to discover the causes of the global financial crisis in a book by Mia and Sufi called The House of Debt. This is one of the most important economic problems and has tremendous implications and applications for policy making and for understanding how the economy works. In this lecture, we will go through the first three chapters of House of Debt, which opens with a mystery. It describes on a small scale how huge numbers of jobs were lost in several counties in Indiana by people who were making recreational vehicles. At the macro level, over the period of this crisis, 8 million jobs were lost and 4 million homes were foreclosed and led to hunger and homelessness at the highest levels since World War II. But why did this happen? Why did this huge economic crisis occur? There were no physical destruction of resources, no hurricanes, no wars, nothing that could be seen as a physical cause of the huge crisis. So in hunting for causes, we should look at what happened before the crisis. And Atif, Mia and Amir Sufi start out by showing that the levels of debt increased heavily. Of course, this description is already guided by theory. We have various theories about how the crisis occurred, and one of them involves debt. And that's why we're looking at debt. And in fact, Mia and Sufi intend to show that this is the main cause. So in arriving at this picture, which is the data on debt, we have already incorporated a huge amount of theory into why we are looking at this data. And so what they start with is by looking at how the household debt doubled from 7 trillion to 14 trillion from over the 7 years from 2000 to 2007. And they show that this is similar to what happened in global Great Depression of 1929. The debt tripled from 1920 to 1929. So we see that one of the factors that may be responsible is that the huge rise in debt occurred before the financial crisis. Also, another factor that you can see in the data is that the global financial crisis was started by a huge fall in consumer spending. Of course, this could be just a coincidence, just things which happen together without having any causal connection. But the international evidence shows that the same pattern is visible in many different countries. So Mervyn King studied recessions in 1990, and he showed that the highest levels of debt corresponded to the biggest recessions in the countries that he studied, which were Sweden and UK. Similarly, Reinhard Rogoff studied the big 5 recessions, which are mentioned here: Spain, Norway, Finland, Sweden, and Japan. And in all of these, the pattern is similar. There was a collapse in asset prices, and that led to a banking crisis, and that led to big recessions. But all of these were also preceded by large increases in debt and large increases in asset prices, which occurred prior to the fall or collapse in asset prices. There is a strong point of view propagated by the finance industry that these crises are banking crises, and therefore it's necessary to bail out the banks to prevent crises. But Jorda, Schulrich, and Taylor study data from 200 plus recessions in 14 countries, and they find that it's buildup of debt which leads to the severe and long recessions. If you have banking crisis and low debt, you have a normal recession. But banking crisis with high debt leads to the worst case of recessions. So in all cases, there is a strong association between the level of debt and the severity of recession. So this is a pattern that's visible globally. The issue remains that is this a causal relationship or is this a correlation? There are alternative theories about how crises occur. The fundamentals view, the supply-siders say that the production in an economy is governed by the amount of capital and labor. Now, in this basic supply-side view, which was the dominant view at the time of Keynes, if there is no reduction in the capital, no capital has been destroyed by wars or weather or by political disturbances, and there is no reduction in labor, no massive disease, plague, something which wipes out the population, then the production should remain the same. Now, in fact, in global financial crisis, there was no such destruction of capital or reduction of labor. So this cannot be an explanation. Now, the more modern brand of supply side also takes into account expectations. So one explanation from the supply side is that people had a strong belief in future prosperity. They thought that house prices would continue to rise, and so they took on debt, but somehow their belief about the future changed, and this is a fundamental. So when they changed their beliefs that then this led to a collapse as a self-fulfilling prophecy. The debt was a sideshow. The main cause is the expectations about the future. Another variation of this is animal spirits, that the expectations are determined without any rational reason. They just occur because people just are exuberant or very pessimistic or optimistic. In both of these cases, in all of the supply side scenarios, there's nothing you can do about these things. They just happen. The theory which actually governed policy making during the financial crisis is called the banking view. And it says that the main problem is the weakened financial sector, the banks which have lost a lot of assets due to the mortgages defaulting and the houses pricing collapse. So because of their weakness, they cannot supply the credit needs of the economy. And so the solution is to strengthen the financial sector to make it possible for the banks to lend more. And there is no such thing as too much debt. So the problem is not debt, not too much debt, it's too little debt. And so the solution is to give a lot of money to the banks to enable them to lend more. And so bailing out the banks is essential to save the US economy. Roughly these ideas were propagated by the US government, by Bush at the time of the crisis. Similar debates about the causes of the Great Depression in 1929 occurred between the supply-siders and the demand-siders, and they have never been resolved. To this date, major macroeconomists have said that finding the cause of the Great Depression is one of the great unsolved questions of macroeconomics. But this time, as opposed to 29, we have data, huge amounts of data, so we can trace the effects of key variables and distinguish between different hypotheses using high quality data that is available. And that's why we're going over this book, because it shows how we use data analysis to decide among different theories. So at the time of the Great Depression, there were three main theories. One of them was Friedman, and that corresponds to the banking view, that the banks collapsed and the Federal Reserve Bank did not bail them out, and this caused a reduction in the money supply, and that was the cause of the Great Depression. This corresponds very closely to the current banking view. Keynes said that the crisis was due to the collapse of aggregate demand, and so reduction in consumer spending. And we saw this pattern both the global financial crisis and the Great Depression were started by a huge drop in consumer demand. And there's a third theory of Fisher, which is called the debt deflation theory. Keynes' theory doesn't take into account the role of debt, but the Fisher's theory says that when you have a large amount of debt and for some reason prices go down, like asset prices, then the value of debt in real terms becomes very high. And so when the value of debt becomes very high, then it becomes much more difficult to pay this debt for wage earners. And so this sets in place a spiral where people try to get jobs to pay off debt, but in this competition to get jobs, wages are driven down and the prices collapse further, and it makes it even more difficult to pay off debt. So the debt deflation theory is the third theory for Great Depression. Before we go into the detailed analysis of the data, we present a big picture of the results that follow. And basically, we learn from the data analysis that it's interest-based debt which is at the heart of the problem. In this situation, when you take a debt, then when the borrower, whether the borrower does well or poorly with the debt, he has to pay the full amount to the lender. So the weaker party, the borrower, bears the risk, while the stronger party, the creditor, bears no risk. This, when there is a shock, it causes the collapse of the weaker parties, and this causes the system to collapse. And this is one of the great strengths of the Islamic finance system, that it requires sharing of the risk in proportion with the capital investment. So interest-based debt is forbidden. And so basically this leads to the good news that there are solutions to the problem, unlike the supply-siders view, which say that these kind of crises just occur naturally and there's nothing we can do about it. There is a lot of things we can do about it. We have to change the nature of the financial system. The Great Depression, the global financial crisis are man-made disasters which come from bad institutions, and they can be fixed. The 30-year mortgage system in the USA is a very cruel and unjust system, because what happens is that the homeowner puts his life savings of $20,000 to purchase a home of $100,000 and promises to pay installments for 30 years. If the housing price declines by 10%, then his net worth 50% is wiped out. If the housing price goes down to 80,000, then all of his life savings is wiped out. This is because the decline in the house price only affects the claim on that house in the mortgage belongs to the bank first, and then the homeowner second. It is not that they are partners in the ownership. And if you have the Islamic system, which is musharaka, in which the homeowner and the bank are partners, if the bank has put up 80,000 and the homeowner has put up 20,000, then the two are 80 to 20 partners, in which case a decline affects them in this proportion. That would be a just and fair system, and that is the Islamic system. And that would have prevented the global financial crisis, as we will see as the book concludes. So a simple Islamic reform of eliminating interest and replacing it by musharaka would have eliminated the global financial crisis, would have prevented it from happening. To understand how the crisis had differential effects on the rich and the poor, we look at a graph of this asset possession. So this is how the data is coming in to help us in understanding and analyzing. If you look at this, this divides the population into 5 quintiles from the poorest to the richest. And if you look at the graph, the poorest have the largest amount of debt. That's the black bar. And then they have home equity, and then they have financial wealth, which is very small. So their home equity is small and their debt is very large. This is called leverage. They have high leverage because their ratio of equity to debt is, or debt to equity is high. As opposed to this, if you look at the richest, they have only financial wealth and a very small amount of assets, a small amount of debt, and larger home equity. So they don't have any leverage. Their ratio of debt to wealth is very low. So basically, when the interest contract wipes out your equity, then it makes it impossible for the poor to pay back their loans, as opposed to the rich, when their debt is small and their wealth is large, then they can easily pay back the debt if they are wiped out. So once the poor people are wiped out, then they have to work harder and they have to work more. This creates downward pressures on wages, and that's the deflation part. And when the wages decline, the prices decline, the real value of debt goes up, and it makes it even harder for them to pay back their loans. From the previous graph, we see that the net wealth of the poor households is tied up in their houses, the equity in their houses, whereas the rich have lots of financial assets. So we see how the fall in the collapse in the housing prices that took place in the global financial crisis affected the different segments of the population differently. In the poorest 20%, almost their entire net worth was wiped out, and that's the top graph. In the middle 20%, there was a substantial decline in their wealth, but in the richest 20%, there was only a small decline. So this is what happened as a result of the collapse in housing prices. And furthermore, what happened was that over the period of the crisis, the bond prices went up for reasons that economists can understand, and the stock prices fell, but then they recovered. But the bonds and the stocks are held only by the richer households. So they were insulated against the shock because they were holding assets which either went up or recovered, whereas the housing market did not recover, and so the assets of the poor were wiped out and there was no relief for them. To sort out different hypotheses regarding the reasons for the global financial crisis, it is very useful to note that across the USA there were many different counties and there were many different patterns of falls in housing prices. And so by using these differences, we can sort out different hypotheses. In general, the higher increases in housing prices occurred in the poorer income counties. This is because there was aggressive lending to high credit risk borrowers. High credit risk borrowers were generally the poorer segment of the population. And because of this aggressive lending, there was a larger, there was more demand for housing and therefore a greater buildup in housing prices. Correspondingly, there was a higher collapse of housing prices in these same counties where there was a higher buildup. On the other hand, there are some counties which were largely unaffected. There was no bubble and there was no collapse. So by looking at the different behavior of demand in these different counties, we can get some idea about which of the several different hypotheses is the right one. One of the factors which intensified the fall of housing prices was the foreclosures and fire sales. Basically, when a person in mortgage fails to meet his mortgage payments, then the bank seizes the property and sells it. But the bank has incentive to sell the property cheaply and quickly because they usually have insurance for any losses they make in this process. So they just they don't want to hold houses. They're not in the business of renting houses and holding houses. So they just want to liquidate them at any price they can get. But the problem is that when you make a fire sale like this, when you make a quick sale at a very cheap price, this depresses the entire housing market because housing prices are evaluated by looking at the sale price of comparables. So if a good house is selling at a very low price, then all houses in the same neighborhood get evaluated, get marked down. And so this is a strong negative externality. Because of these foreclosures and fire sales, the housing prices declined by substantially more than they could have if there was no foreclosures. And this is documented by Atif Mia and Amir Sufi in this graph on the right hand side, which looks at the difference in fall in housing prices between two kinds of counties. One kind of county had judicial process required. You had to go to court in order to foreclose on a mortgager, and this always took longer. And in other counties, you didn't have to go to court. You could just do it directly and quickly. So in the counties where you could do foreclosures very quickly, the housing prices declined by much more because there were more foreclosures. In the counties where you had to go through judicial process, you had to go to the courts in order to foreclose, the housing prices declined much less. That is the dotted line. So this is how the data shows how much foreclosures matter for declining housing prices. The popular explanations for the global financial crisis is that the US government allowed the Lehman Brothers in September 2008 to collapse. And this caused panic in the financial markets, and this ultimately led to the global financial crisis. So this is in conformity with the banking view. But this graph provides the data against this view in the sense that it looks at three components of spending. One is consumption, one is residential investment, and one is non-residential investment. So the businesses, not residential investment is investment in houses, which is done by households. Basically, the flow of credit would affect business investment. So if the banking view is correct, then it is the non-residential investment that should decline. But if we see the charts, we see that the decline is already starting in 2007 with large drop in residential investment and also in consumption spendings, while the non-residential investment remains high. Furthermore, if you look at how things happen in quarter three, when the Lehman Brothers collapsed, you see that the spike in consumption is very large, and the decline in non-residential investment is small. As you go for 2 quarters with high decline in consumption, then the decline in non-residential investment follows. So what this picture suggests is that first consumption started declining, then the businesses cut their investments because they foresaw that consumption is going to be low, so there is not going to be demand for our products, so we should reduce our investment. So again, this graph suggests that the consumption was created and triggered by the fall in consumption and not by the collapse of the banking, which occurred in quarter three of 2008. Things were happening much before then. Many economists have argued against this view and said that basically decline in consumption and investment occurred due to expectations. Consumers foresaw that there was going to be a collapse, and then they tightened their belts, and similarly businesses reduced their investment in anticipation of the crisis which would happen. So the timing evidence that we have seen doesn't really support the point of view that it was the consumption collapse which drove the depression. In the Great Depression, Friedman had argued that it was the collapse of the banking and the contraction in money supply which caused the depression, whereas Keynes had argued that it was the collapse in aggregate demand. So our data shows that the pattern and timing of events that happen is consistent with Keynes but not with Friedman. And how this is determined by Mia and Sufi is that you look at different counties, and as we have said, the collapse of housing prices was very different in different counties. So we look at some counties in which there was virtually no decline in net worth over this period, and those are the in the dotted line on the upper line. So in these counties, consumption did not actually decline. There was actually no recession between 2007 and 2008. Consumption actually kept increasing. On the other hand, in the counties where there was a huge collapse in net worth of the people who had houses, then this collapse led to their reduction in consumption, and you can see that there is a sharp fall in their consumption expenditures in the counties in which there was high net worth decline, where when people got wiped out, they reduced their consumption. If people did not get wiped out in the counties that housing did not collapse, they did not reduce their consumption. So here we see that the crisis is due to consumption, and if it was the money supply then that mattered, then we should not see this difference. Economists generally do not like the idea that debt matters, because they say that one person's debt is a liability, but the same debt is held by others as an asset, so it should cancel out. So they are arguing against Mia and Sufi that there is a decline in consumption. Okay, we think that might be important, but it may be purely due to the wealth effect. That is, when the housing prices decline, then the net wealth held by households declines, and when the wealth declines, it is well known that the consumption will decline. So that does not matter according to this idea. But there is a counter argument that the foreclosure externality, when people with debt were unable to pay mortgages and the banks foreclosed, then they had fire sales, and this led to a much bigger decline in housing prices. So this would not have happened without the debt. And another consequence of the idea that it is only the wealth decline and not debt which matters is that how the net worth is distributed across the population should not matter, as long as just a pure wealth effect. So we will see that that is not true. The distribution makes a difference. So here is the data which shows how debt matters. And basically in this data we look at leverage households, and we look at their marginal propensity to spend on automobiles, because data is available on this factor. So we see that the poorest households are the ones which have the largest leverage, and they have the largest marginal propensity to spend. When we use poor in this, throughout this, we are talking about households which are buying houses. So these are not the real poor who don't have money and who cannot eat. These are the at the bottom of the middle class, as you might say. So the houses with the least amount of leverage, these are the richest households. They have the smallest amount of marginal propensity to consume. So if you wipe out the net worth of the poor households, there will be a much bigger reduction in purchase of autos. If you wipe out the net worth of the rich households, there will be a much less reduction in purchase power. And this makes intuitive sense. If you reduce the wealth of a poor household, that will affect their consumption much more. The rich have a lot of excess money, and if you reduce their wealth, it will not hit their consumption as much. So this completes the first 3 chapters of House of Debt, and the evidence that we have gone over, the statistical evidence, shows that the recessions were preceded by buildup of debt, and they were triggered by a collapse in consumption. The housing asset price collapsed, but this has differential effects on different segments of the population when you have interest-based debt. And in particular, those who are debtors are wiped out, their net worth is wiped out, while those who are creditors are least affected. And consumption collapses when the net worth of the masses, the big proportion of the public, falls. Consumption does not collapse if you wipe out the net worth of the rich. For example, the dot-com crisis, which took place around 1999-2000, had a similarly large impact, in the sense that similarly large amount of wealth was wiped out, but it did not have an effect on consumption because it was the wealth of the rich who had invested in these stocks. But when the same amount of money was wiped out from the poor, then the poor stopped consuming, and this is what triggered the recession. There are three main lessons that I would like to extract from this discussion and study of the first three chapters of House of Debt by Mia and Sufi. The first lesson is that we study data in light of theories. All of the series that we studied emerged from theories that we had about the world. There are thousands of data series. Among these, Mia and Sufi selected the series for debt because they had an idea that debt is what is driving the results. Then we studied the series for foreclosures and how the difference between states which had judicial procedures for foreclosures and those which did not. Why would one think to look at such an obscure thing? Because we had a theory about how foreclosures work in the real world. So the process of learning from data involves starting with theories to look at which tell us what type of data to look at, then looking at the data and modifying our theories in light of what we learn, and then using these new theories to look at new aspects of the data. So there is a continuous back and forth between theory and data and theory and data. One cannot be data alone and one cannot be theory alone. And in econometrics, there is a tendency to do data alone, and in economics, there is a tendency to do economic theory alone, and both of these are harmful for understanding the world. The second major point is that data analysis is very simple. We look at data and we see, oh, this was high, that was low, this number is big, this number is small, compare, associate, very direct, intuitive, and simple. This is in huge contrast to econometric theory, which is enormously sophisticated and complex. What happens is that we make very difficult and complicated theoretical assumptions which substitute for understanding of the real world and actually get in the way of understanding what the data is trying to tell us. The third important point, which we have not made so far, is that in every statistical analysis, an argument is involved. Somebody is trying to push a case for something and against something. So here we have considered two cases. One was the case of the banking view, which supports the interests of the financiers, and the other was the Mia and Sufi view, which support the interests of the poor lenders. As you may know, it was the bankers' view which prevailed, and the policy that was made ended up giving trillions of dollars to the banks which were responsible for the crisis. The policy was based on the wrong theories. The wrong theories were established because of the power of the financial lobby, just like the tobacco lobby succeeded in preventing action against tobacco for a long time by creating doubt about the true theories. So similarly, the banking lobby has created doubt about the real causes of the global financial crisis, and this continues to this day. This battle continues to this day.